Eric Ervin, you launched the Reality Shares Dividend ETF, the DIVY, back in December, and it's really beaten the S&P 500 ever since. Does it have something to do with the volatility, that dividend payers are inherently more stable than the rest of the universe of stocks?
Yeah, actually, it's funny you mentioned volatility. That's kind of the whole point of the Reality Shares DIVY ETF is to cut out the noise of the markets. What it does is it isolates the dividend, and then it captures the growth of that dividend over time by hedging out all of the price risk in a stock.
And you're not buying individual stocks for this ETF. That's the interesting thing about it. Can you give me an example of what's actually in the fund?
Yep, precisely. So what the fund does is it captures the dividends of the S&P 500 and the NASDAQ 100 at the index level, meaning the entire index. Only half of the companies, for example, in the NASDAQ pay a dividend right now, but as other companies start to pay a dividend, that amounts to growth of the actual dividend. So the fund uses options and derivatives in order to hedge out all of the price risk and leaving it with only this dividend component and essentially capturing that growth. So
for example, another dividend fund might have an individual stock and you're holding either a future or an option as opposed to that. So why don't you explain once a little bit more how your fund differs from the other dividend funds out there?
Yep. So every dividend fund that we've known up until this point, we've always thought of one thing, which is yield. What's the coupon? What's the yield that it pays? The difference here is as that yield increases over time, or as that dividend increases over time, it could be completely wiped out by the stock price. In this case, what we have is options and futures that just capture that dividend and then capture the growth of that dividend over time. No stock price. For example, Coca Cola maybe paid $1 dividend 2 years ago, and now they pay $1.25. Well, that's 25% growth. The stock price perhaps maybe is up, maybe it's down, but I know that it has a lot more volatility than the growth of that dividend. So we would have just captured the growth of that dividend.
And I'll assume you back tested this?
Oh, absolutely. Yeah, this is a strategy that's been in the institutional marketplace for years, over 15 years, well over 15 years, in fact. So it's just never been able to be delivered in an ETF strategy that the retail investor could buy.
So now you're bringing it to the masses. So what's next? Can you use this on international stocks, or is it harder because it's hard to tap those markets because you, once again, you're using futures and options?
Yeah, absolutely. So the key is there a forward market for options or futures? Is there a large broad-based index? And then can we conceive it? It's really any index at the broad-based, whether it be S&P, Euro stocks, NASDAQ, it doesn't really matter. We can deliver this product.
All right, thanks a lot for coming on and talking about it. It's great stuff. And thank you for watching The Street.